Joining me right now is Oxbow Advisors Managing Partner Ted Oakley. Ted, kicking things off with you, your reaction to that big sell-off in stocks yesterday. Do you think it's over just yet, or will we see another tough day?
Well, I don't know about today particularly, Maria, but I think generally we'll probably go back and forth. We do look for some more weakness, but I think it comes more in the second and third quarter, but hard to say right here.
A number of market analysts have been worried about higher rates, about this transition that the Federal Reserve is taking, Ted, from an easing stance to a tightening stance. Yesterday, the Odeon Capital Group chief financial strategist Dick Beauvais was with me talking about banks. Here's what he said in terms of expectations on the Fed. Watch. Dick, you just said the same thing. You're expecting a tough market. Is that in step with your expectations, 20% sell-off and 5 rate hikes?
I think the probability of that happening is very good. I think that people have got to start looking at the Federal Reserve balance sheet, because if the Federal Reserve was a private bank and you looked at that balance sheet, you would say this company is insolvent. The reason why you would say that is because the Federal Reserve's source of money, which comes from printing, it comes from collecting, money from the banks, in reserves, comes from a couple of other places, is in deep trouble.
Ted, your reaction. Tell me about investing in 2022 and 2023. Does it get tougher given the new reaction around rates and the reality of a much higher competition to stocks potentially?
Well, Maria, I think that's a good point. I would be surprised, or we'd be surprised if you got 5 rate hikes, but on the one side of investing, we're a little bit against the grain now because we're thinking that growth and inflation doesn't mean they go away, but we think they'll slow down in 22. And if they do, obviously that will have some impact on the stock market. It'll be hard for us to see a year in 22 that was anything like 21. I mean, we're looking for a fairly tough year this year. So I think on that point, you're going to have to know what you own and you're going to have some liquidity.
So, what's priced into the market, do you think? What are the expectations, Ted? We were just looking at a graphic of all of the Federal Reserve meetings this year. We've got a Fed meeting next week. Do the rate hikes start next week, or are you expecting it to be March?
My guess is, Maria, they're not drastic typically in what they do. We think they're always late, but my guess is they wouldn't do it next week. But I think people are trading off the news. That they're hearing that, hey, we're going to raise 2 times, 3 times. Some people are talking 4 times. And so they're trying to really front run it. But we don't necessarily think that'll work out exactly that way. But I think that's where we're headed.
Well, then there's the macro story, right, Ted? Goldman Sachs CEO David Solomon saying that he's seeing, quote, real wage inflation everywhere in the economy. Goldman's costs for compensation alone hit $17.7 billion last year. That was up 33% from a year earlier. And JP Morgan CEO Jamie Dimon told me the same thing about wage pressure when we had him on this program last week. Listen to this.
So here's the amazing thing. With all we talk about the supply chains at Omicron, we're having all this growth with supply chain problems at Omicron. And that's the way I would look at it, not the other way around. And I think it's just slowing down the growth and slowing down the recovery, but you still have a very powerful economy underneath. And yes, probably one of the first times in my life, there's huge pressure and wages and people.
For the first time in his life, Ted, he said he's seeing huge pressure on wages and people. What is that? How does that play out?
Well, I think that's correct, Maria, but I think they're looking backwards. In other words, we think most of those numbers that they're keying off of they hit their peak in the fourth quarter of 21. We think 22 will have a slowing of that. It doesn't mean you won't have inflation, but it'll maybe be half as much as what people are thinking in their minds. And the other side is that growth won't be quite as much either. If you already look at the Atlanta Fed and some of the numbers that are coming out, they're already lowering the numbers for the first quarter. So I can't see us going along the same path, and they're correct about looking backwards, but I don't think that'll do them any good in 22.
So real quick, Ted, how are you allocating capital in the face of all of this?
Well, Maria, we have a balanced approach. We have a growth strategy that in that growth strategy, we have about 25% liquid. A lot of those companies are too expensive for us to add on to right now. We have a high income strategy. We think you have to have some cash flow. That's not a bond account. Those are things that have a lot of cash flow to them. And then we have a really conservative strategy. But we think you have to be balanced this year. To us to be locked into one area, like either commodities or tech or just one thing, will not do you well in 22.
All right. Ted, good to have you on. Thanks very much